So I'm going to share with you one of my secret weapons tonight. Okay. It works obviously in Forex and it works in futures. I want to talk about obviously the example of using the midnight opening range and the benefits of having that information. So, 1 minute chart here on the NASDAQ. Okay. I'm not going to counsel you to look at the video I posted prior to this one in this playlist. So, the 2025 lecture series on my YouTube channel, The Inner Circle Trader. I gave you an example last night where my son and I were working with this very concept here. Okay. And how I could predict the low of the midnight opening range and what you can use with this information going forward. How is it helpful to you as a trader? What information does it help you collect? What can you utilize with this information for setups, stop management? All those types of things are crucial and they're helpful, really. So, without going through all of this movement here, where we used the CIVI last night and used all this frame of reference and then shorted this fair value gap, which was also optimal trade entry, I want you to think about how I taught the opening range in the morning session that's being specifically aimed around the 9:30 to 10 o'clock in the morning 30-minute interval. So that segment of time, that is the algorithmic opening range. There is absolutely, I don't care who tells you what, there's no other opening range except for that 30-minute interval. Okay? If it's less than 30 minutes, it ain't algorithmic. It's just somebody trying to make up something. But the algorithm absolutely uses that first 30 minutes. And it does the same type of thing at midnight, New York local time. So you're going to be looking at it through electronic trading hours. Okay. And by having that, you're going to be able to see basically, Globex hours trading. That means the off session or non-regular trading hours. When you have it on electronic trading hours, what you're going to do is you're going to grab your vertical line here and you're going to find midnight. And you always have to make sure that your chart is set to New York time. I don't care where you live geographically on this spinning rock that we call Earth. So at midnight, we have this beginning reference point. So that's the beginning, and this is the end at 12:30. So you find 12:30 on a 1 minute chart right there. See that? So now all you have to do is find where is the opening candle at midnight right here. That candle, the low, and the high. There's 3 reference points there that are very, very crucial to me as a trader. So when I coded this algorithm, I wanted to have the benefit of having the parameters of a daily high, a daily low, and that way I can find the plethora of setups between those two daily range extremes. So that means I could trade with the idea that I know it's likely to reach to this degree of price because it's going to be the high of the day. And I can trade to this degree of price because it's going to be the low of the day. And while I'm in between both of those reference points, if I know what time of day it is, I know how I can implement the meat basically on that bone between the high and low of the day. So there's a plethora of setups in between those two reference points. Now, it's not my goal to teach you how to pinpoint the daily high and low, but I'm going to give you some hints like I did to my paid membership students in the 2016, 2017 mentorship, where I was teaching them daily high and daily low. Now, there's a lot of things that go into that. And again, I'm not going to just simply divulge that because that is such a degree of, there's no competition when you have that. Like, there really is no competition to it. But you don't need to know the very high or low of the day, but you can anticipate a rough idea where that might be a couple times a week with what I've already taught my YouTube channel. And I'm going to give you some more information here. So it kind of like will help you if you have all my old videos from Baby Pips days. You can go back and use this idea here and back test and see exactly what I was doing. And it was just like I'm showing you here tonight. Okay. So what three reference points are we looking at? Well, the first thing is the opening price at midnight. On this candlestick right there, I'm going to plot that like that and widen this up a little bit. So we have this level here. So that's the midnight opening price for power three. Power three is your daily range candlestick formation. This high is the midnight opening range high, and this is the low of the midnight opening range. Okay, so this information, once you have it, it provides a great deal of insight. All of this move here, I anticipated that and was showing you where it would draw down to. And it's really based on simple liquidity. This low right in here, this inefficiency, this is a buy side imbalance, sell side inefficiency. And then we have the liquidity resting below here. So these are all draws in liquidity. And I was mainly using this frame of reference there. So if we go back over here, once we have this information, I'm now going to take these lines that are vertical off. Okay, so you don't no longer need them. But now you know what it looks like and how to frame it yourself. In this drop here, from the high down to the low of the midnight opening range, I want to look for inefficiencies, order blocks, breakers, any PD array that I've taught in month 4 content of my paid membership and mentorship lectures. The way you look for that on the YouTube channel is go into 2016 ICT private mentorship playlist and look for month 4. And I'll go through in that number of videos, I go through my PD arrays, the first introduction of going through them. Not all of my PD arrays are taught in that playlist, but the majority of them are introduced there. Not all 81 of them. So if you notice this level right here, this single candle right there, that is your first reference point where the largest degree of displacement takes place. Notice that? Now, sure, we had a SIBI over here, but this one right here, much more pronounced, okay? Much more prominent. It really jumps off the chart. So by having this and measuring that inefficiency, we can now have a graded inefficiency that can be utilized. Oops, I just grabbed the wrong thing. We can use this information and go forward by having and real quick, last night I taught you that see how this closing price is below the next candle's opening price here? You see that? So this candlestick's close, the bottom end of the body basically, that is lower in value than the opening price of that candlestick. So that's why I'm putting that shaded box on the wick of this candle and not this close, okay? And the same thing over here. This candlestick's close is lower than this candlestick's open. So there's no volume imbalance is what I'm basically getting at. If there's a volume imbalance, you have to make sure that you encapsulate the SIBI or buy side imbalance, sell side inefficiency, BISI, which would be the opposite of this. This is a SIBI, one single candle that's bordered by previous candle that doesn't share the same range and a subsequent candle that doesn't share the same range of this one single pass through on here. Okay, so now we have this extended through, and now this displacement, the algorithm will refer back to that. It'll go right back into that range. And how will it use it? Well, we have gradient levels here. The lower quadrant, consequent encroachment, which is the midpoint of the range high and low that creates this single sell side imbalance, buy side inefficiency, and the upper quadrant level here. And then obviously the high and the low respective of this inefficiency. Now, by having this information, we can go forward and use things like fibs that give you mathematically derived projections to where the daily highs and the daily lows will form. Now that sounds crazy, right? Like there's no way. Come on, ICT. You can't do things like that. Well, you can't, but I can. So if you take the high here of that opening range at midnight and we plot that like that, you see that? Now I'm going to go into the settings. So you can see again, here is my Fibonacci settings. And if we add things like negative -0.5, -1, things of that nature, we can get projections that will take us above these relative equal highs. How high can it go? How high can it go if it's going to sweep above this level here? And how low can it go when it starts to break lower should it do so? Well, if we scrunch this thing up here a little bit and we apply the fib both directions. So here's negative 0.5 and then -1. And then we have the standard deviations that are projected lower down here. And now we have things that we can project going forward. We have some relative equal highs up here, so there's buy side liquidity. And we can anticipate price running up into these levels here. And then we have standard deviation -1. Now, what is that measuring? Like, what is it that you're actually getting from that? You're getting the range low of the midnight opening range, that 30-minute interval between midnight and 12:30 Eastern time. If the market trades above it, then it can go 1/2 of one standard deviation or one standard deviation. So in other words, the actual range from the high to low, that range added to the high. That's all it is. So think like measured move. How hard and fast it goes to that degree of premium or discount is relative to an economic calendar event during London. Okay, so this is all helping you trade London session. That's what it's really based around. And I'll give you some more details in a moment. Just bear with me, okay? But just to give you the nuts and bolts, if you will, this is a very easy brass tacks approach to finding the one or two levels that generally, not all the time, but generally will deliver what you're going to be looking for a daily high or daily low. We have relative equal highs over here. You see that? So this one here is enough to do that. It trades up into it there. But then we have standard deviation 1 up here. So watch what happens later on in the day session. But for right now, I want you to look at what we have in London. Okay? We have the standard deviation based on this inefficiency. If we take the range from low to high, that's this low here to that high, half a standard deviation, one standard deviation. If we use the inefficiency, we can do the same thing there, where we can take those levels and now we'll plot them from low of the inefficiency to the high. So this inefficiency here, if we use that same idea of standard deviations from that, we can also get very, very precise elements to how the algorithm will rebook and redeliver to premium and discount, even inside of that midnight opening range. What do I mean by that? Well, this is first presented displacement. Okay, the displacement in and of itself is a PD array. Remember, we already had a inefficiency offered here, here. Okay, so it's not that it's, you know, sell side imbalance in of itself. It's a very large one, and it's occurring inside of the midnight opening range. So it jumps off the chart. It's the first presented displacement. Notice that? So what happens when I add these same levels that are here, -1 and -0.5? What if I add that to this inefficiency on the upside? Well, you get these things like this. You get the 50 or half of it. That's this level here. Look what the bodies are doing. You see that? Look at all this. The close of that candle, the open of that candle, all this consolidation around there. Look at the bodies here, here, and it moves away from it. And then we have the -1 standard deviation here. What is it doing? It's creating this delivery of that high. Look at the bodies working around that and all the consolidation around here, and it runs away from it there. Now, what happens when we use this same idea and we add it to the projection below this inefficiency? You start from the high down to the low. -0.5. You can see how we're working this level here, and then finally at -1 standard deviation, we see it here, 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 and then rallies and starts working inside of that displacement in and of itself. So we can see there's boundaries that can be created with this. So the markets are absolutely not random. But now watch what happens when we trade outside the band of this range. Notice we're probing below it here, but it's only going one standard deviation of this inefficiency with that low right there. Remember, go back to it and look, see? Look at it. It's controlled. It's only allowing one standard deviation outside of this when it went lower. I'm not interested in seeing it go below that low because I don't think it's going to do it. Why? Why was I interested in only getting out when it went down here? Why was I doing that? Because this inefficiency told me that this one standard deviation down here is about as far as it'll go once it trades to my target 3. Look at the video from last night. Okay? So once we get back inside of this inefficiency that's in purple, then I can start looking at the quadrants, the consequent encroachment, and the high and the low of the actual inefficiency. So you can see the low of the inefficiency here. Again, that's this candlestick's high. It's supporting it here, rallies up to upper quadrant, trades back down. It trades just outside of it here, but then goes right back into the middle and starts consolidating around the consequent encroachment or the midpoint of that purple area. Then the market trades one more time lower, and now it's allowing price to go outside the range of this inefficiency because it's it's enticing. It's luring traders to go short, and it's probing for liquidity below this low, and anything that's around here, they'll probe at and try to see if they can get that. But they got a short-term low here. They worked below that and then rally back up inside of that purple shaded area, which is the first displacement in the midnight opening range. The market rallies back up, trades to the high of the opening range at midnight here, then back down to consequent encroachment. Consequent encroachment, that's the red level, which is essentially just half of the purple shaded area, which is this inefficiency. So we get to the low of that inefficiency again here. What time of day is that? It's 2:41. That's London open. You want to be trading the London session. ICT, can you please do a London session? Can you talk about the London session? I'm doing it. I'm doing it. It's right here. This is the stuff I was doing with pound dollar, euro dollar, and I was smoking the Forex market. So we're looking at this rallying higher. We took this period of short-term highs here. That buy side was taken here. And then where's it go? Right back down into that first displacement in the opening range at midnight. Creates a short-term low. It trades below it again and goes right to the lower quadrant. Look at that. You can't get any plainer than precision. Look at that. Look at the low. Okay, look up here. Look at this value right here. Okay, keep your eye on that. Right there. Okay, see that low right there? What's that low? 21,705.50. Now watch, ready? We're going to take our time travel way back here at this random candlestick that was just picked out of the thin air, right? What's the value of the lower quadrant? 21,705.50. So the market does what? What is it going to do here? What's it going to do? It delivers on 3:30 macro. In London session, go back through my Forex lectures. I tell you very specifically at 3:30, that's your sweet spot. Don't take my word for it. Do not take my word for it here. Don't just say, well, ICT said it in this video on January 7th, 2025. No, 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 no. Go back through my lectures in the 2016, 2017 and listen to what I'm talking about. So at 3:30, the market starts to run away from lower quadrant of the first displacement in the midnight opening range. The market rallies aggressively up to some random projected level, negative 0.5, and then creates a retracement, makes a higher high, fails to take out the high, and then we trade back down into the first displacement again, stops dead end at the high at 5 o'clock. Now, London session is done. Okay. What's going to take place now? We focus on the day session. Now, what we'll do is we'll scrub over to and jump right into the 9:30 session here. And notice how we traded up in the electronic trading hours right ahead of the New York opening bell at 9:30. See how the price trades up here? Look at this. That's that -1 standard deviation on the midnight opening range. See how that delivered that? And then you have this nice turtle soup rally up and then breaks down. You see that? See that right there? Now, inside of this area here, okay, I want to refer back to a reference point that's found in regular trading hours. So we're going to go to regular trading hours real quick. And I want you to look at this little area right here. You see that? So right here, that's the opening price here and the difference between where we settled the previous day at regular trading hours. See that? Boom, boom. Those two reference points there. So now watch. If I highlight that volume imbalance, because that's what this is, and I'm going to highlight that with this shaded color, okay? Now, because I have this here, I can go back to electronic trading hours. Having this regular trading hours reference point, that volume imbalance, and extending it forward, and we're going into the 9:30 opening here. The market takes a dive, trades. Look where the bodies are. You see that? That's that midnight opening range. See how it did that? See how it's respecting that? Gann had nothing to do with that. Wyckoff has nothing to do with it. Her cycles has nothing to do with that. Sam side and supply and demand had nothing to do with that. Volume profile had nothing to do with that. VWAP had nothing to do with that. Nothing to do with that. And the market does what? It rallies right back up into that same area. And then look where the bodies stop. In my volume imbalance. In my source code. My reference point that I say you can go no further. You stop right here. And the market breaks down once more. And it does something that I've taught in 2024 and mentioned in audio in Twitter Spaces in the summer of 2022. Inversion fair value gaps. Well, let's add that real quick. So the market's doing this. It's going from here. And see, look at that volume imbalance. You see the difference between this candlestick's close and this candlestick's open. That green candle here, there's a small little portion of price action right in there. And let's take away this extent, right? We don't need that over here. And if we look at that volume imbalance right there, we have to use that when we're referencing buy side and sell side imbalances. So this inefficiency on the upside, normally we would expect it to trade back down because anyone that's watched my work, they'll say, oh, it's one of those fair value gaps. It's simple. You just go in and you buy that. Wrong. Wrong, wrong, wrong. The idea is we've already made a run and created the high, and then it bumped it here at 9:30. The high of the day is getting rated. Then it trades lower. Everybody wants a dog pile on it and go short. And then they send it right back up to that imbalance, that volume imbalance. And then we have this move lower. And this is an inversion fair value gap. So once we trade through it, coming right back up into the bottom of it. Look at the bodies. Is the bodies respecting the halfway point? Yes. You want proof? Let's do it. Here's the midline. Look at the bodies. Stopping dead in its tracks. Boom. Lower she goes. Lower. Okay. And let's aim for 640, 21,640. And then we'll be content with something like that. So we can go in here and do something like, I don't know, maybe show some executions. And there we go. Boom. Inversion fair value gap. And taking profit, selling short two more, and then doing another quick recovery in there. So we're seeing that we have no real interest. I'm sorry, I said I went short there. It's me adding, going long. So covered, went long, and then sold the two contracts there. So I did two things there. I went short. You can see it there, short, buying it back, and then going long and going long. You can see it right behind that, right here. Going long there and going along there, and then feeling out of it right there because I wasn't content with holding it. I wanted to see it come back up and bump into this, and then I was going to reverse and then add more going short. But I didn't like what it was doing, so it is what it is. In here, once we traded down into consequent encroachment of the midnight opening range, it's the 30-minute interval between midnight and 12:30 Eastern time. We went to consequent encroachment, traded back up to the high. Look what price it's touching. What's this dashed line? Remember that? That's midnight opening price, hour 3. So we can say that right here, that's the high of the day, this candlestick. The open is here. And one more time, they pass back up into a premium. We break lower, inversion fair value gap. Michael gets short, rides all the way down, slices through the midnight opening range. And look what it does. It leaves it aggressively. It's no longer interested in coming back to test it as a resistance or premium array. That's what? It's indicating the market's extremely heavy. So look for lower prices. So we can see that the market does in fact offer my 21,640 and it pushed down there aggressively. And with slippage, 21,630. And then I did some reversal trading in here to try to scalp a little bit and was able to finesse a couple little points in there, but then buried that idea quickly because we couldn't even get up to this level here where I wanted to go short and hold on to it for the regular trading hours gap that was afforded, traders that were looking beyond just simply yesterday's opening range gap. So I told you I would look at things with the Forex market. So let's take a look at the Forex pair and Forex.com. That was always the broker data feed I used when I was teaching Forex. And here's pound dollar, or cable, as it's usually referred to by as Forex traders. All right, so now let's go back through real quick because this is already a very, very long video, and this is not what I intended to do, but I apologize. It's just sometimes it's just going to be like that, right? I'm going to say there would be days like this. This guy loves himself too much. All right, so we're looking at the same thing here. We're going to look at the midnight. Start here. So we have midnight candle right there on a 1-minute chart. Notice that here, 1 minute. And then we're going to do the same thing with 12:30. So that way it'll give us the midnight opening range. So that's your range, okay? And what you're doing is you're getting 3 reference points there. You can add the fourth one being the highest high and the lowest low and the opening price. But we're looking at this candlestick here. Since it's a down closed candle, that means the open of that body is your midnight opening price. So we're going to do this. So there's your midnight opening price for power 3. And then we're going to look at the low in between these two vertical lines. What's the lowest low right here? All right. And then we'll make this pretty little color purple. The color purple. That was a great movie. I don't know if you guys watched that. That was one of the real. Let's make it bright, real beefy. That's one of the good movies that came out during the '80s. Whoopi Goldberg and a number of other great actors were in that. All right, so we have our opening range at midnight, opening price, the low, and the high. So now with this range here, what can we do? Well, we can grade it. That means we do our run from low to high. Okay, and it'll allow us to do what? We can see price runs, and more specifically, inside this range, we're going to highlight that. So that way we can project it throughout the entirety of the day. And we'll see how that is influential with price action. And let's do it purple. We'll do it like that. And then we'll extend it to the right. Okay. And then now, this here, we can do things like run standard deviations off of this, where there's one standard deviation. Then we can do the displacements. Like this is the first one here. So that's your first displacement higher, leaving this consolidation here. So you can take that and project that into the day as well. Kind of like treat it like it's the first presented fair value gap. And we'll make that white simply because it should stand out now, okay? Notice it's also encapsulating the opening price at midnight. You see that? So there's a couple things there that are agreeing, and also this is consequent encroachment of this entire range at the midnight opening range. So there's a couple things that are converging in their confluence in this little small little range of price action. Let's scrunch this up. Okay, and I want you to you can see how we have the market reaching higher, and then it dives back down into negative -0.5 here. Look at the bodies here, and then look what it creates right there. Relative equal lows. You see that? That right there is a trap. They're just letting that look like it's just real good support. And then they rally it higher up. Takes us up into, it looks like it's a standard deviation 6.5 or 6, maybe let's do 6.5. Yeah, 6.5. And the market rolls away from that and then drops right down into, what's this time? What time is this? What time is that right there? 3:29. In Forex, I taught you the sweet spot for London session is exactly 3:30. And that's when the algorithm comes in, fires off. And what's it doing? Oh, it's just randomly trading down into that first presented fair value gap inside of the midnight opening range. Oh, my goodness. Virginia? I believe this young man's got something here. And I don't think I've ever seen it in any other person's books or courses or mentorships. My goodly, my goodness, look at this. And then takes off. No, it rallies, trades right back down into the midnight opening range, and then sends price higher. And then works off of the negative -0.5 level and the -1 level. And then rips through, tears the face off of traders that are short here. Way up here. So it takes the buy side out here, consolidates as all-time distortion. And then we have the market drop down here. What's coming at 10 o'clock? Well, if you look at the economic calendar, we had the ISM PMI number and we had the JOLTS number at 10 a.m. Eastern time. And that's what we're seeing here. The market dives down, and then at 10 o'clock, it does what? It wicks through up to this SIBI here, which is also a breaker. High, low, higher high. There's your breaker. The trade right into that. Hammered it. Just a wick outside because the wicks are allowed to do the damage. And then the market breaks aggressively lower. And it's almost like it was telling it way in advance at midnight that it wants to do these types of things. But I'll leave that up to you whether to decide there's any value in this. But this is one of the tools that I used when I was doing Forex, and I didn't want to teach it to anybody because it's just a secret weapon. It's one of the things that source code handlers, let's say it that way, they have that advantage. And all of your best moves are going to springboard off of things like this. And I have lots of these types of things. This is just one more of those 81 PD arrays that unfortunately puts me in a different category of technician, puts me in a different category of visibility because I don't see open, high, low, and close. I see what the algorithm's doing. I see the reference points that it's going to go back to today, in the afternoon, tomorrow, next week, next month. That's what separates me, and that's what makes me an inner circle trader. That's what makes me that. Those things, I will never hand all those advantages to anyone else. My children will see them, but even in their hands with me teaching them, they're seeing how it's not easy. It's not easy to have what I have. It's not easy. And it's normal for you to see all these things and say, man, this is really complicated. But here's how you should take this information and go forward with it, okay? And then I'll close it. I want you to think about how we're finding the framework with this information. The opening range gap, we taught about that yesterday. Wasn't the first time I talked about it, but that's your first beginning point. The framework that you use around opening range gaps is derived by the midnight opening range. That's the 12 o'clock to 12:30 Eastern time. Before you even wake up to trade the New York session, you should have at least referred back to that area of price action and carry forward that information like you're seeing right here. Every significant price run, I promise you, I promise you, every significant price run that's worth its measure in terms of significance, the move that every trader wants to be a part of, that's where my PD arrays shine. They ferret out all those types of moves.